As traders and investors, we are constantly bombarded with news from business and finance, and that news can quite often be conflicting. In the current news flow, earnings seem to be holding up, certainly if you look at bank earnings particularly, but there appear to be cracks emerging in the global economy. The IMF recently cut its global growth forecast, citing supply chain disruptions and the pandemic. But at the same time, central banks are increasingly aware that rates will have to rise, possibly sooner rather than later, to cool the rise in prices. How should we interpret the world from a global macro viewpoint? Well, joining us today on the pod is Rick Bensignor. He's founder and chief executive of the Bensignor Group. Rick, it's great to be able to catch up with you. Thanks indeed for your time. I know you're a very busy man. First of all, your view of the markets. So what should we be aware of?
Well, Jeremy, thanks for having me on today. What should we be aware of? Well, I think right now when you're talking about markets and, let's start with equity markets, you've really seen over the last 6 months, give or take, a very distinct barbell approach that the major sell-side firms, certainly in the U.S., are looking at the markets with. And I mean that in the sense that you've got a slew of almost a half a dozen tier one firms who had called for a really significant decline, 15 to 20% type of decline in the market that we would see. And then, of course, you have the staunch bulls who are looking for a very solid year-end movement in the S&P and 4,700 or even higher by those people. And in round numbers, the S&P is, let's say, about 4,550 or so. My view is that both of those camps are going to get it wrong, and that the S&P is actually going to be somewhat stagnant through year's end. So even despite the fact that we're essentially on all-time highs right now, made relative to the high that was made in early September, I actually don't think that the S&P is going to materially advance from here. And I've cautioned clients about getting overly bullish at this point, and that the likelihood is that we kind of just go sideways. We don't have to revisit the low that we made in October, but I also don't think that we're going to keep pushing higher. The same elements that were at force just a month and a half ago when the market came off are still at play. And those issues haven't really disappeared. And I think that we're going to surprise a lot of people by actually just not advancing the way, at this point, most people are thinking we're going to keep pushing higher.
Let's pick up on that point, if I can, about GDP forecasts. The IMF, as I said, they've cut their forecast slightly. To what degree should we be concerned about this, do you think? Is this the tip of an iceberg in terms of bad news on global GDP? Or is this just a transitory slowdown or softening in what is otherwise going to be a good picture over the next couple of years for GDP?
I think it's a softening, Jeremy, in a sense that we've come a long way. Certainly, if you go back to the great financial crisis and the bottom of the markets in 2009, if you look at where that occurred and where we are now, the market has made huge strides well beyond what many people ever forecast coming out of that crisis. And in general, things have improved and keep mildly improving. And the market shows us that and anticipates that it will continue to. However, I do think that after the years of advancement that we've seen in the stock market, the next few years are not going to produce the same type of results. We're getting closer to longer term targets that I've had. In fact, I'll tell you, back in 2014, I was the head of cross-asset trading strategy at Wells Fargo Securities. And in the summer of 2014, the S&P was trading at about 2,000. And I put out a forecast then, a 10-year forecast that the S&P would hit 5,000 in about 10 years. Of course, at the time, it got very cool reception. And, you got to be kidding, Rick, and that kind of stuff. But here we are already north of 4,500. And I kind of think the next few years will have very much slower modified growth. And you're not going to see the 20% returns like we've seen plenty of other years along the way. And I'd be more inclined to think that the market's going to be getting closer to its long-term average of 7 to 8% return per annum, which historically has rarely ever happened. It just happens to be the average over time. But the S&P is very funny that everybody kind of knows it rallies 7 to 8% annually. And yet, if you look historically, it's virtually never rallied that amount in a year. I kind of think the next couple of years are going to be sub double digit. And even if you get double digit, it'll be very low double digit. And it wouldn't surprise me if one of the years really just goes simply nowhere.
What about inflation? Because we've heard this word transitory used by a lot of central bankers. And in terms of inflation, over the weekend, Twitter and Square chief executive Jack Dorsey said the US will experience hyperinflation soon. Now, I mean, he's not known for his deep understanding of economics, let's face it. And some may say he has an angle to grind with his exposure to crypto markets, which he says are a hedge against inflation. First of all, inflation versus hyperinflation. Just take those apart for us and tell us exactly what each does and how we should approach each, if indeed each comes about. How do they differ?
Well, inflation is just your standard too much demand for not available enough goods that pushes prices higher. Hyperinflation occurs when interest rates move up. You still have demand well exceeding supply, but it becomes rather erratic and such that I don't want to use the word hyper in its definition, but it really kind of gets out of control and zooms dramatically higher, costing people well more for just outright cost of goods and services than is typical. If you look at a society like you'll have, let's say, in Argentina, where politics rule the roost all the time, and that's a country that is very used to having hyperinflation. A cup of coffee can go from costing $1 to $5 overnight because of how they peg the dollar and what they do there as far as economic/politics of the day. So I don't know if the U.S. is going to really get into a hyperinflation period, but I do think that the inflation that we're seeing now, which is much higher than the Fed's targets, 2% give or take, and we're seeing 4, 5, and 6% come out from CPI type numbers and PPI numbers, I do think it's here for a while, and that we're going to have to get used to higher energy prices, higher costs. You go in the supermarket, I was just noticing what a radical difference in price some products are. Even really, really simple basics, like I was buying oatmeal the other day, and the cost is something like almost 30% higher than the last time I bought it. Now, we all know grains are in a bullish move. In general, commodity prices have moved higher. In fact, pretty much other than gold and silver, virtually every commodity is strongly higher. The inflation argument, I think, is a good one. Investors are positioned for inflation and have been since September of 2020, way ahead of the Fed, way ahead of Chairman Powell saying whatever inflation we have is going to be transitory. He's the one who's kind of coined it and used that. And I think now he's starting to see and recognizing more that it's not so transitory and it's real. And having, today we hit in WTI crude in the US, we hit $85 a barrel. So we haven't seen that type number in, I think, in about 7 years. Inflation is something that's going to stick around and something we have to live with. Whether we end up getting hyperinflation, I don't know. And I concur that Jeff Dorsey is not one who's usually going to tell you that's not the resource to go to.
Absolutely. Good as he is at his job. Let me just quickly steer you on to how we should deal with what you've been describing here in terms of GDP and inflation. What is the best case sort of setup for the markets then at the moment? You're talking there about an S&P might be going a little bit higher, but may not be going too much higher. A little bit of a pullback in growth, a little bit of inflation. And this all seems to me to be like going back to normal. We've gone through a period in the last 18 months where we've seen an absolute trashing of economies because of the pandemic. We're recovering. We've seen some big markups in GDP. We can't go on doing that forever. So a little bit of a pullback in GDP in my book is not such a bad idea. And of course, the thing is about inflation is, look, we've all got so much more debt than we ever used to, or certainly we've been told that. And in fact, if you get a bit of inflation, that shrinks debt. So this all, to me, looks like good news.
It used to look. Yeah, as you say, it looks like it used to look when markets had inflation. It's been a long time since we've had real inflation to deal with. And a lot of younger listeners aren't even going to know what we're talking about. But if you go back, pre-2000 and you go into the 1980s and 90s, you had dramatic inflation. Interest rates were much higher than they are now. Now, young folk think of a U.S. 10-year as, this thing that yields virtually nothing. And, why would you even bother with it? But you go back to 1980 and 10-year was at 15%. And the long bond, the 30-year was at 18%. So people really had to deal with inflation. Mortgage rates a heck of a lot higher. And it wasn't uncommon to have 7%, 8%, 9% mortgage rates. Now, everybody's concerned if they're paying more than 3%, they think they're getting ripped off. So, yeah, we're going back to what was, and that's kind of economic cycles and the fact that things do return to long-term equilibrium over time. It's not the easiest to always time those type of things, but markets ebb and flow, as do economies. And we're getting back to more of a textbook type economic cycle.
What about the FX winners and losers in all this? Where do we go for chasing good returns on the FX markets? Traditionally, in times of stress, the dollar's been a good bet. We've seen the dollar rise recently against the Japanese yen, which is always quite a good trade, especially when you get these rising yields. That's a good trade to follow. That seems to have gone its course for the time being, at least. Where do you see the winners in the foreign exchange markets?
It really all comes back to the dollar because virtually everything's versus the dollar. So it's really key to get the dollar right. If you can get the dollar right, then you can figure out which currencies are often the better pairs. So let's talk about the dollar for a second. Dollar is near the highs of the year. In the end of December, starting January of this year, dollar bullishness was the largest consensus macro call on Wall Street coming into 2021 is that the dollar would get pummeled. And coming into the year, when I saw those polls and thought about it, it quickly reminded me back to 2016. So in November of 2016 in the US, Donald Trump gets elected as president, and he gets inaugurated a few months later in January of 2017. From election night through December 31st, the dollar ripped higher in anticipation of him coming into office. And the largest consensus call going into 2017 on the macro front was that the dollar would rip higher in 2017. It peaked the first trading day of the year and never saw that level again. It was down the whole year. Coming into this year was the exact opposite. Dollar bullishness was the minimum we had seen. Everybody was bearish the dollar. And I look at the models that we look at, and I kind of have reasons to think otherwise, that if anything, the dollar is a decent buy. And I went out with that call right then and there at the start of the year. Don't be surprised if the dollar consensus call is completely wrong and we trough very early in the year. It happens to be that first week in January, the dollar made its low for the year. And all those who've been fighting the dollar have not made any money. And in fact, they're in some, if they have positions on, they're in some pain. Just 2 weeks ago, the dollar made its highest level for the year. And we're right back against some highs from a couple of years back, so that there is some resistance in the 94 handle for the DXY, the US dollar index. My thought was that I'm less bullish dollar now, so I'm waning my bullishness, but we could still get this spike higher that finally cleans out the shorts and the dollar pushes higher than, the recent highs and gets to 95, 96. There, I'd probably be more apt to be a seller. So I think that, to me, it's not so much about which currency to be in, it's about the timing of when the dollar is going to stop this rally. And if you can figure that along with the interest rate differential and the potential carry trades that have worked before in the past but have not worked well as of recent, those may end up coming back into play. So yes, it's very possible the Japanese yen ends up being a currency to be in. But I think it's too early, Jeremy, to make that call yet, because I've got to get more convinced that the dollar isn't going to put in one more final leg to really punish the bears who have been on the wrong side of this trade all year.
Just one final thought, if I can steer you towards the subject of gold, because for some people, I talk to a lot of gold bugs. I know a lot of people don't like gold, and I understand the reasons why they don't like gold. Let's face it, there's not much of a benefit in holding it other than the fact it looks nice and you get to
shiny.
wear it every now and again. Well, it's shiny. It doesn't pay you a dividend. You get out of the highs, you buy at the lows. You've got to time that properly to make any money out of gold. Where do you think gold is going at 1780, whatever it is at the moment? It's tapping on the door of 1800. It's got this this inverse relationship with the dollar, of course. And in local currencies, gold has done well, obviously, depending which currency you're in. What do you see as the message around gold? Do you think that its luster has been stolen by crypto, by Bitcoin?
Yes.
Do you think that story is now going to be increasingly important?
I think it will be, because so many people are looking at crypto, have made a very significant amount of money with crypto. Gold, you've had to wait a long time being a gold bug to have made money. And look, the last few years were terrific until this year. Gold is down on the year, or if it's up minimally. Let me just take a quick look. Yeah, it's still down just a tad, whereas stock markets are higher. Crypto obviously is significantly higher. Other assets are higher that are supposedly hedges. Gold, in theory, should be moving substantially higher, with inflation knocking at the door and continually coming in with the type numbers that CPI and PPI have. So you'd expect gold to do better. To me, the fundamentals for gold are still pretty decent. And this year was kind of the anomaly where it just hasn't partaken. It peaked August of 2020 and hasn't been able to advance or even come close to getting over $2,000 again. I do think you've got to be really patient when you own gold, and it deserves a small piece in your portfolio. I'm not opposed to the standard 3% that people always used to say have a small exposure in gold. But in this day and age where people want to see results really quickly, and say people who are the crypto fans have pretty much seen tremendous returns in short amount of time. And if, of course, like anything, if you time it wrong and you bought Bitcoin 6 months ago and you had to watch it, have itself before coming back, now you had to be some patient. But, if you're an investor as compared to a trader, that patience is part of the game of being an investor. And gold finally paid off. You just had to hold it for a long time. So part of this, Jeremy, also depends upon, are you the type person who has to see instant results, or are you willing to put a small piece of your portfolio in gold as a hedge, as a way of, essentially a non-correlated asset that really is more dollar dependent than anything. And there are periods even when gold and the dollar move the same direction instead of inversely. But I think the long-term fundamentals are still there for gold. It's just gotten a lot of interest taken away by this thing called crypto, that people are saying, well, here's now your hedge. Here's, if everything goes wrong, you want to be in crypto. So a lot of gold buyers probably aren't there anymore. And they've moved to this much more high-flying type of investment that drops 20% in a day and 50% in a month. You got to be willing to play with that. It's tough to think of crypto as an investment unless, and this is what I tell people on the retail side, if you're not willing to lose 100% of what you put into crypto, as if you never had the money and it does not alter your life in any way, if you're not prepared for that, then you shouldn't be in it.
But that sounds to me like a bit like put it all on black. That shouldn't be the investment strategy, surely, should it? If you've got a chance of losing the whole lot, then that doesn't sound like investing to me.
I agree, and that's why I think if you're going to put money in crypto, you have to be prepared for huge swings at any time. If your timing isn't good and you don't buy when there's blood in the streets, be prepared to lose a chunk of money. And if you happen to need that money so that you're forced to sell at a bad time, be prepared for, if you're going to play the game, know what you're playing. Don't go into crypto with the eyes half open. Understand that you're trading something that has tremendous volatility, a difficulty in actually knowing what the true fundamentals are. And to a large degree, you're playing a greater fool game. You need somebody to be more foolish than you to buy higher than you. That's just out of money.
Just out of interest, I mean, you and I have been in the markets a long while, if you don't mind my saying, and you have a lot of experience behind you. You have a good track record. Are you into cryptos, or are you staying back?
I personally own some Ethereum. I bought it earlier this year. At my average price is about $2,300. And I watched it go to 4,000, then to 1,800, and now back to 4,000. But I was willing. I didn't put enough in that it would really hurt me if I was dead wrong and it was wasted money. So I'm never going to get rich on it. I don't have 20% of my portfolio in it. It's probably a heck of a lot closer to 1%. So, I kind of did a flyer, and let's just see if this puppy can get to 5,000 or 7,000. And, I don't know what it's worth. I was willing to put some money in and say, I might be an idiot or maybe not. We'll see.
Okay, look, Rick, we've got to leave it there, but thanks indeed for joining us and your honesty as well. It's great to speak to you.
Anytime, Jeremy, my pleasure.
Thanks indeed for your time. That's Rick Bensignor. He's founder and chief executive of the Bensignor Group, and that is today's IG Trading the Markets podcast.